Hey everyone, if you're thinking about buying a home, you've probably heard the term buying down a point or paying points. But what does that actually mean? And is it worth it? Let's break it down in English under 2 quick minutes. Let's go. When you take out a mortgage, your lender offers you an interest rate. But did you know you can actually pay to lower that up front? That's right. That's what buying down a point is. 1 point equals 1% of your total loan amount. Here's an example. Let's say you're getting a $300,000 mortgage. 1 point would cost you $3,000 in additional closing costs. Buying that point could lower your interest rate on average between a quarter to half a percent. Though the exact amount depends on the market condition and, of course, your lender. Why would you want to do that, you ask? Because a lower interest rate means lower monthly payments and potentially thousands saved over the life of the loan. Here's an example. On a home with a $300,000 mortgage at a base rate of 6.5% versus 6%. At 6.5%, the principal interest payment would be around $18.96 a month. And at 6%, the principal interest is $17.98 a month. That's a difference of $98 a month. So spending an additional $3,000 at closing would save you $98 a month. So your break even point would be roughly 30.61 months. Let's round up for 31 months. Now, you're planning on staying in a home for a while, say 5 years or more, buying down a point could be a smart move. However, we need to consider the current market conditions, the projections, and the forecast to see if it might be beneficial for your situation. But if you're planning to move or refinance, you may not break even on that upfront initial cost. Buying down points isn't right for everyone, but it could be a powerful tool in the right situation. You want to crunch the numbers and see if it makes sense for you? Reach out and I would love to help. Like, comment, subscribe by hitting the button below. Talk to you later.